Right, so it's time for the 12-month performance review. As you know, each month I have a different approved list of stocks for the subsequent 12 months. And starting all the way back last year means that we've got the 12 months up till the end of November, start of December 2021. So, how did those 12 months do up until the end of November 2021? How did those stocks do? How did we perform? Well, anybody who knows anything about the markets knows that we had a great tailwind, so I can't take credit for everything. So let me share with you in the big reveal. Here we go. That was the performance, 25.8%. I'll break down which those shares were, all our holdings, everything else. Those of you already follow me on my Telegram channel, I will know what these stocks are because you got them last November. Okay, at the start of last November 2020. So this is, the start of last December 2020, because it's 12 months, remember, to the end of November 2021. And that was the performance. And what was it composed of? Well, let's look at what it was composed of. And let's ask the big questions. Why do some stocks go up 100%? Why don't all of them? And so on. So these were the top performers of all of those from December 2020 to November 2021, the 12-month period. And by the way, I should say, how did that compare to the previous month? So the 12 months preceding that was about 53% up. You've seen the videos on that elsewhere. And the month before that, it was very similar to this. It was 35 point something percent as well. Of course, the stock names are largely different because as each month goes by, you'd pick different ones, wouldn't you? Sometimes there's a bit of an overlap. So let's look at some of the big performers. Now, why was it that if you're using the same methodology, valuation of this company's earnings relative to their share price, revenue growth, sales growth, in that regard, and you're also looking at earnings growth, you're looking at cash flow, cash return on capital invested specifically, outperformance of the markets, consistency of outperformance of the market. So to get technical for a minute, we're looking at Alpha and Sortino as well. Why is it that using the same methodology, some stocks did incredibly well, in cap up 259%, Camtech 143%, and so on, but others didn't do so well? Well, that's because if we could predict which one was going to be the best performer, we would have just put all our money in that. And that's an important reason why people diversify, because they're not diversifying in case the markets fall. They're diversifying because they don't know which one or two or three stocks will do well. So they need a sufficiently large basket of companies. So how does that performance look? Well, these are the names of all the ones which are up over 100%. I'll give you the full list, including the ones which didn't make a return, in a second. Okay, and you can see they're from a variety of sectors. That's interesting fact number one. They're largely from NASDAQ, though we've got NYSE and LSE in there as well. So could you talk about geographies? Well, it's a mixture of geographies, mixture of exchanges, and mixture of sectors. So those weren't the common factors. Okay, and you might argue, well, actually, they weren't the really big, large cap companies. Yes, that tends to be the case. You know, an elephant doesn't gallop. In other words, a billion-dollar company other than ASM hardly about to become, or I guess you've got more than that. They're not about to. Well, even that's only 163 million in market cap. Sorry, 16,000. So that is over a billion. Okay, and then you got 3 billion on Skyline as well, 1.5 billion on Camtech. The rest are all under a billion, with the exception of Perseverant. Okay, so 338 million with the others. Anyway, have a look at those numbers while I whittle on. And what that tells you is, yes, of course, the ones, I guess if there's a sweet spot, but you're reading too much into the data, I think, if you're doing this without wanting to sound like Professor Whitty, it's roughly around companies at 100 million. Remember, this is after they got 100% return, maybe 100 million market cap when you're starting out, to 200 million, and those are more likely to go up. That could be one argument from the data. What about the ones which went up 50 to 100%? Still fantastic returns. What do they have in common? Well, market caps here, you did have quite a few billion pound companies, or billion-dollar companies, if you can do the conversion in your head. And is there a sweet spot value there? That's a bit harder. Is there a sweet spot exchange? That's a bit harder. Sweet spot sector, a little bit harder. I know you'll find patterns don't try and look for patterns. It's human nature where they don't exist. So be careful about that. Remember, my approach is valuation, growth, income, dividend yields, cash flow, consistency of outperformance, lower volatility. All of those factors. I want to tick every single box. I'm not like a fund manager who says, oh, I only want UK growth companies or Japanese income companies or US tech companies. No, I don't believe in picking from either a narrow gene pool by style, or I don't believe in being racist and saying I'll only pick British companies either. Okay. So those are the numbers. Well, let's look at the whole performance, including some of the underperformance, the ones which didn't on that same approach do as well. And this is the distribution curve. Now, what's interesting here is the numbers you see are how many stocks got between, for instance, 8% to 33%, from 33% to 58%. And you can see, and what you want with anything like this is you can see the vast majority, of course, hit the sweet spot, 30%, 40%, 50%. Sadly, you will always have some which underperform, got negative returns, okay, were loss making, but those will be few. And you've got a long tail to the right-hand side, which again are some of the outliers. Now you might say, why don't you just pick the outliers? Well, I wish we had that kind of time machine. We don't. I wish we could see into the future. We can't. Wish we had a crystal ball like that. Nobody has one. Nobody on the planet has one. Okay. And those who might occasionally get it right and said, oh, I picked that one company, that was me, they probably picked 500 others as well. So for full disclosure, let's show you the whole list. That was the whole list from the 1st of December 2020, so 12 months ago. Okay. And it's 12 months performance subsequently using that approach. Doesn't mean we're still holding them now. In fact, we're not. We hold for 12 months and then we redo it. Okay, that's the whole list and how they performed. All the stocks which are on that list, you can see there are some losers. The losers are few in number, okay? And the losses are small in size relatively. The winners are large in number and the gains are far greater, all right? That's what you're looking for. That's the ideal. To reiterate again, the best way to get that is have lots of box ticking, value, growth, income. Because imagine you just pick one geography. Well, chances are you could have messed up. You might have got lucky one year, but you won't keep getting lucky. Let's say you pick one style, valuation or growth or income. You're trying to guess on one of those. You might get lucky one year. You won't keep getting lucky. That's why we tick all the boxes and pick from all the geographies and pick the best of the best of the best. It's common sense after all. It's how you hire people in a company. And each one of these companies you might buy shares in are people you're hiring, they're employees you're hiring to look after your pension or your children's inheritance. So that's why. Anyway, thank you very much. I hope you enjoyed it. Have a look at my campaign for $1million.com, where I teach people for free how to invest. You'll be able to follow me on my LinkedIn channel from there, on my Telegram, on all sorts of social media, and download my books and learn more about investing, all for free. There's free courses that I've created which you can learn more about investing from there. So thank you very much. And I hope you like the performance. And I hope it sort of also explained why some stocks did go up 100%, why some went up only 50%, and what we're going to do to try and replicate that again. What we're going to do, same again. Thank you very much. Not the same stocks, same strategy, valuation, growth, income, cash flow. Because if next year the market decides it wants to pick only certain sectors or certain geographies or certain styles like valuation, growth, well, we'll have ticked all those boxes anyway. So whatever it picks, it'll be coming into our net, right? And that way, in one sense, we can't lose. And I think our returns tend to show that. Yes, the market hadn't up yet. Maybe can't lose is a wrong thing, because who knows what the future will hold them. Might be a nuclear war in which everyone's going to lose. But what I mean is the probabilities, and that's what it's about, the probabilities of losing are that much lower. Okay. So thank you very much for watching.